Hi, this is Randy Finney with the Right Side of the Chart, and today is Tuesday, May 26, 2020. I hope everybody, at least here in the States, had a great Memorial Day weekend, and to everybody else outside the States, hope you had a nice weekend as well. Obviously, the markets were closed here in the U.S. yesterday for the holiday, and so we're picking things back up. What we're gonna do in this video is a quick update on the broad markets, looking at various time frames. I'll try to keep it somewhat condensed. Time permitting, if I get through it, we'll hit on the precious metals and commodities and some of the other trade ideas out there. But if we go much longer than 20, 25 minutes, I'll cap it there and do those in a separate update. All right, so we'll start out here on the longest term. Still waiting to see how the month closes. I've talked many times in the past with this 20-month exponential moving average when you're on a monthly time frame, meaning that every candlestick represents 1 month of trading, and the that blue dashed line there is a 20-month. It denotes bull and bear markets pretty well. You can see it serves, as a line of, separation or delineation, if you want, between the bull and bear markets. And once you enter a bear market, it often acts as resistance above. And once that bear market is over, you cross back, regain it, and the new bull market begins. It doesn't catch the absolute high and low because you're on a monthly time frame, but does a pretty darn good job. I'll put it up there to any single indicator, because you have to give weighting to simplicity on a trend indicator. And so what we had back in the that meltdown back in the fall of 2018, the fourth quarter, we pierced it intra-month, but then we regained it, or pierced it that month, regained it the following month. So like any indicator, it's not without its whipsaws, but usually when you have a pretty big move through there, back then, even in the fall of the last quarter of 2018, we only closed about let me get that crosshair right there. Yeah, about 4.75% below there, and then again regained it the next month. Whereas this time around, we closed, when we had that sell signal triggered, even after the big reversal in March, we still closed 10.5% below it. Last month, month of April, we back tested almost a perfect test to close right around on that level. And again, you don't want to look at it to the exact penny. If you're close enough within a few percentage points on a rally back, you call that a back test. You want to clearly see it taken out. Now, again, it's a monthly chart, so all that matters are the monthly closes. It is not uncommon to see a big move through intra-month to close back only to see it close back above or below. And so right now, we started the month, we were trading most of the month below it. We're right now, I'll do it for you, I think we're right about, as you can see, I measured down the pop-up box to the left. If we dropped a little under 4%, we would close back on it, which would mean simply another back test of the line from below, or a failed attempt to recover it because we went intra-month and failed back down there. So and then you also have this long-term trend line right here. You can see off the lows of 2009 in the SPY. This is what I call my benefit of the doubt trend line. I had one here that was kind of pierced through. So key technical level for the long term, and I know it's not it's easy for some, and I've been doing this for many years, and sometimes it even becomes a little difficult not to get caught up in short-term trends and get lost there, and then fall victim to recency bias, meaning that trends strong recently, it's going to continue that way. I cannot knock the resiliency of this trend off the lows, especially in spite of a lot of bearish divergences and trend line breaks and other sell signals that we've had recently that just didn't play out for much more than a quick 2, 3, maybe 4% pullback. So again, I want to say that I'll recognize the resiliency of the trend, but again, that's usually how, if this is a bear market rally, which I suspect that's how they end. And I said it before, even before we bottomed in March, I said, wait and see. We'll have a bear market rally soon, and towards the end of that bear market rally, you'll want to do nothing but go long. It'll be so convincing. That's the nature of a bear market rally. Again, only hindsight will prove if that is correct, but that's still what I'm going off of, because we're up there. We're pushing I don't want to say the max limits, but we're pretty much at the upper limits of where previous bear markets have ended based on Fibonacci retracement levels, snapbacks into key moving averages such as this 20-month moving average, and then we go down to the daily chart, which I'll do real quick, and turn off all the lines, things like this. The 200-day simple and exponential. As I mentioned, a lot of traders will watch either one of these as key moving averages, and so for weeks there, or months even, we tested the 200-day, kind of took it out, not very convincingly, back tested it, traded around it, and popped above. But as I said, I would say, if from my experience and just talking to other traders, listening to other traders and analysts and all, I would say the majority, more traders probably focus on the simple moving average than the exponential. Although the exponential, like I said, I tend to gyrate towards that one, but I put them up both on my chart because they both are key levels. And again, doesn't matter what I prefer. If more people, or even enough, let's say it's 40% like the simple moving average and 60% like the exponential, and that 40% sell, their longs or short on a test of the 200 simple, then that might be enough to put selling pressure in the market to reverse it. So we're above it now, but again, when you're looking at a daily chart, especially intraday moves, by such a small margin, 0.3%, not really taking it out clearly. So that's where we're at. Same story. We're at resistance. I will give credit where credit is due. The fact that they did put the 200 exponential, clearly in the rearview mirror as of today. But as I said before, you have just a whole mess of overhead supply resistance level, and that's what we're going to do right now. We're going to shift gears and go to the sectors of the S&P. But before we do that, let me just loop back something I wanted to cover. Again, I just showed you, looked at based on where we're at right now. I'm grabbing the top of this candle that's in the works right now. Here's the monthly chart again, to get back to that 20-month exponential moving average. We only have 3 trading days left in the month after today. So Friday's the last trading day of May, so we'll have the candlestick finalized, and you can see the pop-up box. We're about 3.84%, just under 4% above the 20-month moving average. Now let's jump down to that 60-minute chart I started out with today, and let's just we won't assume anything, but let me just point out some measurements here. I was looking for last week, and still am, a backfill at minimum. I mean, even for a bullish scenario, the odds favorite. Odds favorite doesn't mean it's 100%, doesn't mean it must happen. It just means over 50%. I already showed you a chart this morning that every gap, and I'm talking about bullish gaps, even the bearish gaps. A bullish gap is a gap up during an uptrend. So every gap, that was one, backfilled there, little gap there, backfilled, and then some, another gap right there. There's, that when you gap up, it's the bottom of the gap. That means a backfill. So at that point, you backfilled. So you get the point. I did it today. This one, you gap down through it, so it was backfilled there. We had a gap there, which was backfilled on this gap down there. So again, every single, without exception, every single gap up from this point early on in the uptrend, other than this first breakaway gap that happened back there, every other one, that was the first one off the lows. Every other gap has been backfilled since. And so does that guarantee this one will have to be backfilled? No. But, the odds are pretty strong there. So, again, trading's all about probability. And, again, the market usually doesn't like to leave unfinished business. So it's even for the bullish case, a longer-term bullish case, it's almost beneficial to not see this one backfilled. I mean, to see it backfilled and then resume. Whether it gets backfilled or not, let me just get back to my point. I kind of went off a tangent there, but in case you didn't catch the post this morning, I wanted to cover that. That would be, as I told you, we need to drop about a little under 4%. Should that gap be backfilled? It would have to be backfilled or close to backfilled this week. You know what? Even if let me just say this, even if only today's gap is backfilled, that's about 2% below where we're at right now. That would then put us within 2% of that 200-day. And again, kind of for all intents and purposes, when you're looking at such a big price range, on the monthly chart, I'm talking about, from high to low here, 36%, and just these weekly candles, a 2% close above there it's not clearly taking out that moving average. It's effectively a close on that 20 period exponential monthly moving average there. So that's what we're looking at. So how does this week go? Well, let me just say this. If we can power on and close the week well above where we're at right now or today's highs by, even every little bit helps. There's no hard line. There's no 1% says, now we haven't. I would just say this, that the higher we close up above there this week, which again is a monthly close, the more it's going to put that the 200-day simple moving average on the daily chart I just showed you, and that 20-month moving average there. The more it will put them in the rearview mirror and say, look, that's a solid breakout. And does it guarantee that those breakouts can't fail? No, but again, the farther away you get from it, lower the chances. So that's just how that works. All right, and if we have a pretty nice drop this week and we happen to backfill last Monday's gap, I'm referring to this one right here, which has not been backfilled, then that would represent a drop of, from where we're at right now, about 4.81%, and it would close, if we close anywhere around there, or even close to it halfway in the gap, then that's going to put us back down on or above that 20-month exponential moving average, as well as the 200-day simple moving average that I covered. So these are things to watch, and the fact these divergences continue to persist. They've been building, and again, it's not as if they don't work. They played out each and every one. Each of these were divergent highs, and they played out for corrections. They weren't big corrections, and again, that speaks to the resiliency of this trend. But there were corrections off this divergent high. Here was your next one. And usually, it's that you get a, divergent high isn't your sell signal. It's a break of a trend line or a horizontal price support. In this case, we did have a divergent high right here last week. Let me try to figure out the new trawling tools, TC2000. I had to send them a support question today. They just, if you guys are running TC2000 and you're running the newer version, the 20 that rolled out recently, they pushed some update today that changed things. I got a little pop-up message, and the old used to be able to just hold down control, and then it would draw a trend line or whatever the last tool you were using, and now you have to hit Shift D. It's just driving me crazy because you guys know I like to add a lot of trend lines on my charts. So pardon that. I just want to point that out if you're having a hard time figuring out, or let me know if you still can use the old control and then hold the mouse, left mouse click down, left mouse button, excuse me. That's what used to draw the trend lines. So now you either have to go there and do it. All right, back to what I was talking about. So we had a little divergent high right here, a little drop, but this really extends it. And again, it more so extended this one out here. This is still our bigger divergence. It's been building for a while, and look, they could take it out, but they haven't done so yet. It's been building. Get these little corrections along the way while the market inched higher. We went in this trading range for a while, and so you got to give credit where credit is due. The fact that what today did, before we were kind of flirting with the top of that range and we were still flirting with the 200-day moving average. Today clearly put us above the 200-day exponential moving average and also above the recent trading range. So those are levels to watch. I think the odds favor the gap back test. If we didn't have the divergences, all that, I'd say maybe the odds would be a little bit less. And like I said, if that doesn't happen, we go up higher, then it just chips away, if you will, at the case for a decent pullback. Now, I should say, because I didn't really make clear this morning, if all that happens, it could be something as simple as a little 3-4% pullback and we get that gap backfill, depending on how it happens and how it looks on the daily chart. If it happens, there's a potential for a lot more, because we come back there, we'd have a failed breakout of the 200-day simple moving average, the blue line there. If we went down, remember, we're not that far above the 200-day exponential. We're only 2.4% or so above it right now. I'm going to grab the top of the candle. Yeah, 2.8. So, like I said, if we had a backfill of last Monday's gap, it's going to also take us back down below there, and that may would indicate a failed breakout. Now, as I've said in the past, these are levels to watch, and I've mentioned those as objective shorting ops. We went through it, but I also in several times in recent videos talked about how in almost every instance, not just back here, this was the big drop that we had in the fourth quarter of no, I'm sorry, this was our drop into early March, and when we took out those two, I'm going to go back to that other one, but here was the big drop leading into the March lows from the February highs there. And when we took out the 200-day simple and exponential moving average, exponential was on top at the time, simple was below, we undercut it. We came back, we back tested one day, we popped it intraday, couldn't hold it, and then popped it and closed above it. So we took it out clearly on a single daily candle there, and then that was followed by this big plunge there. And then you roll back in time and you can look at the big drop. This was up until this big drop into the March lows. The biggest drop that we had in years was back here in the fourth quarter of 2018. I'm sorry, 2019. Nope, I stand correct. 2018. No, yeah, the year started. There's 20. That was the fourth quarter of 2018. Market dropped over 20% there, and you can see that we had the same thing. We took out the 200, both the 200 simple and exponential. Like I said, they're always going to be relatively close. The exponential is a faster moving. It will respond to prices faster due to the calculation. So when the market goes down, it'll go down quicker. When the market goes up, it'll turn back up quicker. But they come in together, and here's my point is you took it out right here, and then you regained it, and every time you regained it, you were talking several percentage points about where we're at right now. And so again, I'm using these examples, and you can go back in previous bear markets. So the fact we're above it, all I'm trying to say on face value, until less we reverse, is bullish. But should we fail it, should we fail to maintain, should the market fail to maintain, trade above that level for a while, especially to put it in the rearview mirror, start to move up, clearly put it behind. We have to take any breakout there with a grain of salt, because again, that is the typical MO, that you don't just come up, make a perfect back test like we did here and fail. You can do that sometimes. So going back in hindsight, I can say, sure, that wasn't a good time to short, but I can still say it was a very objective time to short, because once in a while you come up and you hit resistance and you get rejected. Sometimes you even fall a little shy. So, but more often than not, the majority of the time, you pop those levels, and what it does, this is kind of my take on how the market works. It clears out a lot of short interest, and it brings in more buyers, more longs that think, okay, we've taken those levels out. Algos will even trade off this, computerized trading programs that, if you're above the 200-day, below it. And so if you get the failure there, that's a failed breakout, false breakout bull trap. So that scenario is still very much on the table, and that's all I wanted to say. Now we go through the sectors of, oh no, before I do that, yeah, let's do that. Let's go to the sectors here, and I want to look at a couple things. Let me put it on back on all these lines. Okay. What I'm looking at here is when the market topped back in February, we started to roll over like anything, and then you had these big gaps. These were the biggest gap downs you can see in many months, maybe even years. Even back here in the meltdown in 2019, you don't see a gap that big. That was a huge gap right here. That was the gap from after the close on February 21st to the 24th. So there was a weekend there. I guess things started to progress with COVID or whatever else. But we also had, as I talked about, it wasn't a random correction. It was priced in. There was a clear trend line break, negative divergence at the high, everything else that precedes these other corrections, or most of the time that precedes. And then you had this, so I refer to that as a very technically significant gap. Gap below it, you back tested it the next day, never looked back. And so Whether we take that gap out or not, this is XLK. This is by far the most important sector. It's 25% of the S&P 500 returns are solely attributed to this one sector out of the 11 sectors. So by far the most important, and it's about half of the Nasdaq 100. So obviously very important there. So there's XLK coming up on a near gap backfill. That is resistance. Whether we take it out or not, only time will tell, but I can tell you it is a significant gap, and there's some other reactions along that level there as well. So I'm just going to go through the rest of the sectors quick, and you're going to see a common theme here. Is you're going to see that gap over and over. Not in every single sector, but most. There's a big gap right there. And you can see that this is XLV, the second largest sector in the S&P 500, and it already made a perfect back test of that gap right there, backfill I should say, the top of the gap, and is still trading below it. In fact, it's trading at the bottom of the gap right now. And it's also been capped by this downtrend line right here, and that's about it. As far as its other posture, it's above all the key moving averages, so it's hard to knock it from that perspective, and it's pretty much like the broad market, been trading around now for the past almost 2 months now in this big choppy sideways trading range, and it, unlike the broad market, is not above that. It's down here. So it's one of the again 11 sectors. I won't go through each and every one of them. We'll just go through the top weighted ones because they're really what impacts the broad market. You get down to the basic materials and REITs, and although they might be great investments or trading vehicles, they are only about 3% weighting, so they're not going to move the needle on the S&P 500. So on XLF, things are a little bit different. That gap is so far up here. There's the February gap when the market gap it doesn't even come into play for anytime soon. It won't. There's a couple other big gaps along the way, and that's where I have one right here. So I have this gap right here. The big gap down, and I also have another box that kind of shows you a pretty significant level right here. We have a couple reaction highs from above right there, and it's really pretty much a thin zone where you didn't have a lot of trades. We kind of went through there, had one day where we gapped down into that thin zone and then gapped down again the following day, and this has been resistance. So this is a level to watch on XLF. And the fact that the financials are lagging so far behind the broad market is certainly a red flag. It's typically not. We are seeing, I will say, in the last few weeks, I've seen relatively decent market breadth, some broad participation. But again, in some of the more important sectors, they've been lagging. And even if they're catching up recently, the bigger picture shows you, XLF, the financial sector, is still off 36% off its highs. Another way to put that is the financials, as with quite a few other sectors, are still solidly entrenched in a bear market. And by every metric that you can apply, you can't say this isn't anything more than a bear market rally right now. In hindsight, sure, if we come up and recover, quite a bit more, we take out those old highs, you could say it was early stage bull market rally. But again, this is a very key sector of the economy and the stock market, and it's not there. XLC, or you could just basically say Facebook and Google. You put those two stocks, they are Alphabet, I should say. They have such a heavy weighting in this sector. It has a decent weighting, 10.6%. But remember, 2 of the 5 FAANG stocks, Facebook, Amazon, Apple, Microsoft, and Alphabet, those are the FAANGs that make up, bulk of the Nasdaq 100 and, and a good part of the returns, the S&P 500. 2 of those are in this, and those 2 are so top heavy weighted that, again, you only have to look at the charts of those 2 to see where XLC is going. Where am I going with this? Well, there's that gap. Again, really technically significant gap, and we're up to the bottom of it. So gaps, the bottom and the top of the gap often act as resistance. So we'll see where we go. If we get rejected here, you're going to have the tech sector being rejected off the top of its gap, and here the communication sector and some of the others that I've already covered, like healthcare, which has already been rejected off the top of its gap after backfilling it. XLY, there's that significant gap, but right now it stands out, and it may come into play if we go up higher. Like I said, there's still a lot of work for the market to do, although some of these sectors are trying to approach their previous highs, and a couple like XLK have even broken out to new highs. The majority haven't, and this is what I'm highlighting here is a big significant resistance level. We had a breakout here, breakout, back test, and a breakout to new all-time highs there, and then a failure. And that whole breakout there proved to be a false breakout or bull trap, and that's what followed right there. And so now we're coming back up to that level again where we broke out. So to me, a very technically significant level, and this is a big sector. It's about 10.25% weighting in the S&P 500. That's consumer discretionary. If it manages to take out that resistance and has that gap to contend with, but I'd probably put a higher weighting on here because we had more reactions on that level. But again, you can't underestimate the significance of those gaps. Again, they're based on where they came right after the markets broke down from these short-term trend lines and divergent highs, and then it really started the ball. It was the catalyst, if you will. Well, that was the real catalyst, the first breakdown, but that sealed the deal when we had those big gaps, and then the bottom kind of fell out of the market. So again, I strongly believe that they're very technically significant, and whether they get taken out or not, only time will tell. XLI industrials, pointed out back here, we had an evening star doji. What stands out to me is you had a pretty significant support level there, and I'll give props to the industrials. So we had a big gap right there, and that gap was tested there, rejected, tested, finally put this little evening star doji, and it did lead. That was a nice correction. That was a nice sell signal. It was pointed out at the time from the top of that evening star doji. The financials fell, industrials, the industrial sector fell about 14%. So it wasn't as if that didn't work. That's a heck of a drop. But as of today, we came back, rallied, test, and we gapped above it. So we'll be watching this. Is this a breakout? We're slightly above that right now, so it is as of this point in time. So where we're at, kind of where we've been for weeks now. The market's in a pretty critical technical juncture, not to the exact penny, but in this range, 2, 3, 4%, 5%, let's say 5% give or take in some of these sectors. So would it be bullish if XLI can build on this? Absolutely. And should this breakout fail right here and we fall back below 64.32, that will be a pretty bearish technical event. What to watch for? Well, a lot of things can happen. One would be another gap down. This evening star doji was also an island top right there. You had a candlestick, separated gaps on both sides. I think that was, the bodies were below there, close enough. And so any type of gap down tomorrow would leave an island top right there if we get a gap down tomorrow, or even later this week. Maybe we trade there again tomorrow. Kind of like NVIDIA I talked about, and I'll try to get to that one here in a second. Let me rifle through a few more of these. XLP, the gap it's not really prominent. I don't even see it. It doesn't stand out here in XLP. What I'm watching here, I have this downtrend line. XLP are the consumer staples, and that makes up about 8%. So you can see we're getting down the line on as far as weightings go. It is still very significant sector of the S&P 500, and it, like quite a few others, is trading below both the 200-day exponential and simple. In fact, right here you can see, I'll zoom in a little tighter, we rallied up and made a perfect test and a failure at that 200-day simple moving average, the blue line, and we're still below it. So we'll see. Is this what the market's going to look like? Is this really the broad market just a little bit ahead of it right now? Because the broad market's right here. If you're looking at one of those "you are here" maps, like when you walk into a park or a theme park or a shopping mall, you are here. Well, that's where the S&P is right now, pretty much testing that 200, and we already did it in the staples, and it's been stair-stepping lower since. So those are levels to watch. And again, I do this because the market is simply a sum of its parts, so I like to go through, drill down into the 11 sectors of the S&P 500 and take a look under the hood, because sometimes what the stock market is showing, that is a stock market, but you want to see relatively good participation, broad participation, especially among those top heavy sectors. So I'm going to stop here on sectors because now see we're at energy, and it's only, I haven't updated these recently, so this number might be a little different. 2.77% weighting in the S&P, and there's a big gap right there. It's that gap happened in early March. Huge monster gap. We're halfway in it, so near term, you can spin that maybe as bullish because gaps, once entered, are usually backfilled. And if we do backfill it, then the top of the gap would be resistance. Sometimes you enter a gap, you don't always backfill it, so we'll watch that. What would be bearish if it, drops out down below there and can't hold that gap. But again, it's not going to move the needle on the market. This is more of a, if you're trading the energy stocks, this is the kind of chart you want to look at. All right, before we wrap up, let's just run through the FAAMGs real quick, and we'll stop there. We'll look at the maybe top 7 holdings in the Nasdaq 100, because again, a lot of those are the top holdings in the market. And what I've done is I've set price alerts. I have several different boards. Here's QQQ. There's one board. I think this is the one I shared this morning. There's a different board right there. This chart almost mirrors quite a few of the FAANGs, including Apple. But I have trend lines alert set. I think if I didn't already set one, I'll do it here again. So I'm watching these trend lines because we have, again, you can see the divergences are still very, very much intact. And I know undoubtedly some are tired of hearing that, and I wish I could say that 100% of the time negative divergences will end up playing out for a meaningful correction or reversal. Like I said, we've had our little one so far. It doesn't work 100% of the time, but it works much, much more often than not, and that's enough for me. So, like I said, that's that little, seemingly innocuous 3-4% pullback, if you will, or gap pullback to backfill last Monday's gap has the potential to trigger some additional sell signals, such as a break of this trend line, such as a reversal back down below the 200-day moving averages, such as a failure to hold and close above the 20-month exponential moving average, things like that. So these are little things I'm watching. It kind of have the potential to lace into the bigger picture here. So there's QQQ, and we'll rifle through the top components here of the Qs. Here's Microsoft. This is a trend line right here. It's almost identical to that QQQ trend line. So right here, that's the one I have a price alert set. If that breaks, that should trigger a sell signal. You can see some of the early support levels that then would come into play. And let's just go on Apple. There's the trend line. I have the alert set under divergent high. Same story. Been diverging. Yes, did we have divergence here, right here at that high? We did. Did it play out for a correction? Yeah, but not very big. We fell right back to support, a very good support level too. A lot of big gold gap right there, a lot of reactions on that level, and that's what we've pulled back to. And so now we need to break that trend line and, of course, break that level 302.24. In fact, I need to set another alert there just in case that goes, because if that goes, things could happen quick. Amazon, same story. Here's your divergence line. Here's a minor trend line. Kind of not doing much, but like a lot of things, especially these market-leading FAANG stocks, kind of just slogging around, trading sideways recently. I grabbed the wrong tool there. Let's see if I can delete that. There we go. But that's what I was trying to show you. I'll do it here. Just that kind of sideways grind that we've had lately, and with the divergence. Next one up, Alphabet, blue trend line right here off the lows, divergence. That's class A. Here's class C, same trend line right there, nice and clean. That's it. So we're walking up these trend lines and other levels, and if they go, you can see some support levels below, and if they continue higher, you have a gap to be backfilled above. It tried to enter that gap, maybe came right in the bottom. Let me just show you what I'm talking about here. Big old gap right here to here. So if I bring that over, yeah, we pretty much rallied into the bottom of the gap and stalled out so far. I'm not going to call it a rejection because we haven't dropped enough, but that's it. And if we push higher and backfill the gap, the divergences, at least if it's only to that point, will still be intact. And still, this is what you need. You need a break of the trend line and that level right there, the price level 1426 on Alphabet. Facebook, little minor trend line there, more significant uptrend line. Facebook is doing better than a lot of the others. And again, as I showed you with XLC, it's leading Facebook's really holding that one up. The communication sector. Intel, same story. We had a little divergence there. We extend the divergence. It's not been taken out. It's only extended. That's it. Eventually, if the stock continues to go up much higher, they'll take the divergence out. But as of now, it's still very much intact. Yeah, a little minor trend line there. It's got a few reactions, so there's one to watch for Intel. And then two more, and we'll wrap it up. And I'm going down the components of the Nasdaq 100 in order of market cap. So whereas Facebook was the 5th largest holding, then you have Intel, which we just covered. This is Nvidia, again by market cap, so it should be about the 7th largest, give or take. And remember a week ago or so, I said, be on the lookout for potential island cluster top. That's when you have a cluster of candlesticks. This is a 60-minute chart. Really, you could look at it on the daily. That's what we'll do here. And I said back then, look, we could gap down tomorrow, or we could continue to build candles, and you'd continue to build an island, and that's what we've done. Now, like any chart pattern, this is very important, especially to those new at trading, because I get this question all the time. A bullish or bearish chart pattern is only a potential long or short candidate. You need, there's different criteria to build the pattern, but then ultimately you need a buy or sell signal. So in other words, while this is a potential island cluster top, it is not an island cluster top pattern. It is a potential pattern. What does it need? Well, you have to then separate this island of candlesticks by a gap down on the other side. So whether you have, trade again tomorrow, even the next day, ultimately if you gap down, that then leaves this island intact. That is your sell signal, and that then you can say that Nvidia put in an island cluster top. They're like any chart pattern, it's not 100% success rate, but they're pretty darn good, and you want to look for them after an extended uptrend. In fact, here's an island top right here, island cluster top, I should say. You had a cluster of candlesticks here, separated by a gap on both sides, right? Broke down, came and back tested, but never backfilled that gap, came to the bottom of the island, and then boom, from there Nvidia fell about 36%. So that's something to look for. Same thing I pointed out last week, but it hasn't triggered yet. May never trigger, but certainly looks like it here. And if it does, again, this is what I want to try to impress, that I'm talking right now about short-term potential pullback targets, because that's all at this point in time. The trend is still up. The market has shrugged off a lot of these divergences with just little pullbacks after each divergent high. So we'll just have to take every move in the market one day at a time. And so if we even get the backfills of those two gaps I'm talking about, if we get this sell signal, then we'll assess it as it goes. But where I'm going with that is, you should be open to the possibility of the potential, because these are major topping patterns. There could be a lot more than a 3-4% pullback if Nvidia gaps down and the broad market and the tech sector also give us some decent sell signals. So the way to trade that, instead of trying to cover on a 3-4% pullback in the broad markets, if you decide to short Nvidia on a breakdown of this island cluster top, set a stop. I wouldn't set it right at the base, because that's where they try to run, and all the stop raids would try to get your shares. So I usually like to set a stop either in the middle or slightly above the middle of the island. Again, that is if you get a sell signal, a gap down below, you short that with a stop there. And what it is the risk reward is really attractive. So maybe you're risking 6% on Nvidia, but the last time it dropped from there, it was 36% or so. And this time there's a potential, very much, I have not wavered on this, that we go down and undercut, or at least revisit and undercut, and maybe a whole lot more below the lows back from late March. There's still the biggest disconnect I've ever seen, or I believe it's ever been in history, between the fundamentals of the economy right now, unemployment data, GDP, retail sales, you name it. This rally was a rally was priced into the charts. A lot of these stocks and sectors, or some of them, particularly tech, have gone up more than what a typical bear market rally would be. Of course, when you go into new highs. However, the majority of stocks and sectors haven't. So where I'm going with that is there's tremendous downside potential. So you can trade. You have to define your trading style. If you were to get an entry there, you can either try to game a quick, depends on you. I'd say minimum target on NVIDIA be about a 5, well, no, from where we're at now, about a 10% drop right about here. Let me give you a level. I'm going to give you a level on top of that previous high, and then some reactions there about 315.70. I might have already given you levels. Yeah, I already did that on here. This was a trade before that was stopped out, but these are some of the old targets. And that stop we had before was at 303.50, and since that has become, without me moving the line, that became a very significant level. We had a reversal there, broke out, back tested it, and went higher. So that would be a minimum target, and then you could look for some of these longer term targets. And again, you turn to the daily charts and say if you get an island cluster top there, and just say hypothetically we just go to retest the March lows, that's about a 40, almost a 50% drop in the video. And I know many don't believe that, but I look at these long-term charts, I see a lot more. I think before what I believe is still to be a bear market in the broad market. I can't say that for NVIDIA when you're at new highs right now, but I still think it will follow, and the semis will. You're talking still about an 88% drop in the stock. I've covered this one in the past. It's coming. This is my long-term swing target or trend target, if you will. Oh, it looks like the video, I must have hit the pause button and I was still going, so I'm not sure where it stopped. I think I stopped talking about Apple when the price alert went off. If I've already covered this, my apologies, but I just want to mention that that one's starting to crack. You want to see a solid break below there. And what I did, and again, I don't know, I might have already covered this because I don't know when I hit the pause button, but 312 would be the first target, 302.24, 289.70 would be a third, let's just say for this point in time, a final swing target. But what happens here is if this 302.24 target is hit, and I could easily see it, I could see a lot more than that is what I could see. It's hard to imagine now with the resilient trend, but that's what the charts are indicating. If that happens, and it happens by the end of the week, that would be a 4.66% drop, almost 5%. That would mean the market would drop roughly 5% because this is a top component of the S&P and the Nasdaq 100, and that would also then mean that we closed the month back down below that 20-month moving average and the 200-day simple moving average as well. So these are things to watch. Again, this was comprehensive for the broad markets. I'm not going to do a end-of-day market wrap unless something crazy happens in the next 38 minutes. Otherwise, I'll follow up with a video or some charts on the commodities, precious metals, and some of the other trade ideas out there recently. This has been Randy Finney with Right Side of the Chart. Have a great day.